The unthinkable is coming. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, Jamie Dimon, the CEO of JPMorgan Chase, is warning investors and consumers to prepare for the worst case scenario. Now it's over to Bloomberg, where we picked today's story up with the headline, UK wage hike to hit shoppers' pockets. This warning pub and retail chiefs. Just yesterday, we heard from policymakers in the UK that financial stability would not impact as many consumers as they once thought. And we made the case, while they're completely wrong, that financial instability is going to get increasingly worse and is going to affect a much broader number of citizens and workers. And here we're seeing even more evidence of just how the political elites make the worst possible decisions and seem to make things even worse than they could be. The measure unveiled during Hunt's autumn statement last month represents an almost 10% increase to the national living wage, a base pay level for many adult workers. It's the biggest hike ever. Here we see just how they're dealing with inflation is to give out pay raises to deal with inflation. And yet what does that lead to? Well, if you're thinking it leads to more inflation, well, you're right. The British Retail Consortium warned that the pay increase, coupled with higher business rates, will, quote, likely stall or even reverse progress on bringing down inflation, with food prices likely to be affected the most. Grocery price inflation slowed to around 9% last month from 9.7% in October, still meaning that people in the UK are gripped with just outrageous rates of inflation. Of course, this doesn't seem to get better because political elites have no idea how to solve the problem they create. They just know how to make it worse. And retailers told Bloomberg they're concerned with the decision could reignite inflation and add significantly to their costs, cautioning that businesses, here we go, may have to cut jobs and boost prices as a result. And this would only make financial instability in the UK even worse than it's predicted to be. And this is exactly the case that we've been making, that failed policy on top of failed policy does not lead to good policy. It leads to high unemployment. And that is just exactly how you get to the next financial crisis. But one place that everyone is hoping is going to turn around, well, and maybe they are a little bit, but don't hold your breath for too long. As China's weak trade data signals more economic pain to come, and here we can see that imports in dollar terms have now declined 0.6% after clocking an improvement the previous month when everybody was hopeful that the global economy was turning around. That was worse than the consensus of, imagine, a 3.9% gain. And what this is referring to now is internal demand from Chinese consumers is weakening, a case that we have made over and over, that as they look out to the global economy and as the world's largest exporter, well, they see it in their factories, in their businesses every day. When external demand goes away, well, their internal consumption is going to fall as a result, regardless of what Beijing tries to do. And here's the evidence. And overseas shipments rose 0.5% from a year ago, slightly better than the consensus estimate, and marked the first year-on-year expansion since April. The resulting trade surplus was just shy of $69 billion, giving some hope that maybe, just in the slightest way, things for China are turning around. But again, it's not going to last. As expected, seasonal surge in trade also failed to deliver because of weak global demand. Exports are usually stronger in the final months of the year due to a boost in demand ahead of the Christmas and holiday season overseas. And this is exactly the case that we made, that the back to school and the holiday season would drive a transitory increase in the data. We said that if it doesn't materialize into a sustained rate of economic growth, that the data would likely roll over and we would now mark another major move down in the global economy. And sure enough, this is exactly what we're seeing out of China, reassurance that there's weak global demand all around. And disruptions from the pandemic in November last year resulted in a steep contraction in trade, which makes the headline numbers this year look better by comparison, suggesting that we're now comparing ourselves to how bad things were during the pandemic and that we're only seeing marginal increases, which is suggesting, as we made the case, that all of the stimulus money, both fiscal and monetary, that juiced up the global economy is going to bring it crashing right back down. And China is telling us that this is a reality. Exports to the U.S. and European Union have fallen by over 10% so far this year from the same period, suggesting indeed the global economy is contracting, while those to Russia surged a whopping 50%. Imports of steel plunged 27% so far in 2023 as a property downturn deepened, while chips declined by 16.5%. So again, more evidence that as we know that the property developers are in big trouble there. Demand from Chinese consumers to buy real estate is drying up rapidly, despite all the efforts of Beijing to try to reignite demand for real estate and turn their economy around. As we've said, it won't work, and sure enough, it's not. It's unclear if exports can contribute as a growth pillar into the next year. Well, it shouldn't be unclear at all. It should be extremely clear. Look at the global economy. What do we see in the U.S.? We're seeing the economy slow down. What are we seeing in the UK? It's gripped by inflation and slowing down. What are we seeing in the Eurozone? The bellwether, the economic powerhouse of manufacturing, Germany, in a depression, dragging the rest of the Eurozone down. Look around the world. Even we'll talk about Japan in later in today's show. Major problems there. And if anyone thinks that somehow that's going to lead to a boost in exports in China, they've got it wrong. But the European U.S. economies are indeed cooling, and China still needs to depend on the domestic demand as the main driver for growth in 2024. And if that's what they're hoping for, well, good luck, because there isn't enough domestic demand in China, even though there are enough people. And what in theory on paper should suggest enough demand to keep their economy humming along, we know that it's just not there at all. And then this turns to what Jamie Dimon has been warning us of. Well, he said it could be here much sooner than people think. As Jamie Dimon says, be prepared for a recession. And this would be the absolute worst case scenario for the U.S. economy, because what have we been told from the political elites and the policymakers is that the U.S. economy is going to experience a soft landing. And it's sure there's going to be a few people impacted, and then it's going to come surging out of that on the backs of a robust labor market, which we've said, and we have more evidence that is starting to crumble and fall apart. But one thing that shouldn't be in a recession, well, that's your trading account, because no matter what the market's doing, you can make money, and I'll show you. It's just this easy. Here we have one of our recent trades that we showed our subscribers. We showed you on our Sunday show how to do this using our reports. Here it is, trading the QQQ, the tech stocks, up 7.7% as the time we're recording this now. Let me show you just how easy it is, because I know some of you are saying, Steve, I've tried trading. It doesn't work at all. I don't make money. Look, it's this easy. Our subscribers, they're making money. They're getting rid of their other expensive reports and saying, Steve, this is so easy. One trade's paying for a year or more of your services. And let me just show you here back on October 9th. We talk about machine positioning every Sunday, because more and more money in the market has been driven by machines. They pushed the market in big ways. We came off a short position on the QQQ. This was our big flag to tell our subscribers, hey, watch this. When this reverses, you want to be on this. And then we get our paired trade. Now, what our most successful investors do is they subscribe to both reports. They've got our Momentum Timer Pro. And this looks at all those technical signals, smooths them all out. And on one daily buy count, we saw technical momentum swing to the positive. That match on October 9th, that triggered that buy at open. That trade now up 7.7%. It's just that easy. And as you've seen on the show over and over, just how many successful trades. Are they all going to be this way? No. But what our subscribers are telling Steve, you've got an amazing hit rate with these reports, and you too could be a part of that. Now, there's 3 coupon codes for a free month for each of them. Try it out. Make some money, and then you'll be a subscriber. If you get to the checkout and the code's not available, it's because 3 people beat you to it. Stay tuned to another day. See if you can grab one. A lot of things out there are dangerous and inflationary, Jamie Dimon says. He said, get prepared. this happened here. He said at the 2023 New York Times Deal Book Summit in New York, he said interest rates may go up, and that might lead to recession. Well, Jamie, I got news for you. Interest rates aren't going up. In fact, they're going down now. And you've been talking rates up, and we know why you've been talking rates up, because your bank has been taking the long position against your hedge fund clients that we know are shorting the bond market in a big way. And we know you're going to make a ton of money. And you can talk rates up, but I'm going to show you they're headed down. As governments across the globe need more money, granted they do, they always do, to fund their green economy, rematerialize, and address their energy crisis, that will all be inflationary. And yet, historically, it's not been inflationary because those things aren't what drives inflation. Jamie, you know these things. But as far as your claim, do high interest rates lead to a recession? Oh, you bet. In fact, here we have the federal funds rate. Let me show you. This is overlaid against the historical recessions. You can see those are the official ones, the government ones, shown in those vertical gray bars. And what do we see? 1, 2, 3, 4, 5, 6, 7, 8, 9 times the Fed raises rates and we get a recession. Everyone's saying the 10th time, including the Fed, this isn't going to happen. Well, we know the Fed has no clue how to manage the global economy, let alone even the monetary policy of the United States. They drive the economy into recession every time. Jamie, you know this. You know. I'm cautious about the economy, he said, and for good reason. He ought to be. The labor market in the United States has been resilient, but inflation is hurting people, and we've said it's only a matter of time before the U.S. labor market comes unwound. We're starting to see the initial signs of that. We've got some more data for you on that later in today's show. He says stimulus money handed out during the COVID shutdowns and quantitative easing by the Federal Reserve had injected drugs directly into our system and caused an economic sugar high. He said, but that's fading. And I think quantitative easing and tightening these geopolitical issues, well, he says they can bite. And he's right, because what happened here is we juiced up the global economy in a big way. And what's happening is we're coming off that high. And everybody knows, whether it's too much sugar or anything, when you come crashing down, it's a big deal. That's where we're at with the global economy. We're at the edge of the cliff, starting to move off us, looking at the way down, knowing that we have no idea where the bottom is. But Jaimin wasn't done yet. He had something else to say about a very popular trading vehicle, which I think many of you are going to take beef with. As Jaimin says he would shut down crypto if he had a government role, maybe suggesting that someday he will. If I was a government, I'd close it down, he said. The remarks add to Jaimin's long history of bashing digital currencies, which he has previously called Ponzi schemes, and a fraud. And his latest comments follow a series of hacks and scandals, of course, we know roughly around the banking system. Now, many of you are going to say, well, this is obvious he wants to shut it down. It's a threat to his way of business. Well, that is a truth statement, absolutely. Be sure to weigh in the comments what you think is what's really going on here. As Jaimin repeated, criticism of the crypto industry doesn't extend to blockchain technology. In fact, he loves it. In fact, which the bank has enlisted several projects. JPMorgan was an early mover with its JPM coin, a proprietary stable coin that allows clients to make blockchain-based payments. The bank has projected the token could be handling as much as $10 billion in daily transactions in the next couple of years, around from $1 billion now. So perhaps he doesn't like crypto, but he likes JPM coin. Who knows what the real plan is there? But again, weigh in the comments, what do you think's going on with JPMorgan, and what do you think Jamie Dimon his real issue with crypto is? But let's go back out to the global economy, where we see problems arising as traders pile into bets that the end of the negative Bank of Japan rate is near. Of course, we could have told you this was likely going to happen because central bankers have this belief that they are in control of their currencies. And when their currencies are in free fall, which is exactly what's happening with the yen, well, at some point, the policymakers are going to realize that they need to tighten monetary policy because they think that is the magic sauce that brings the value of their currency up when all other measures fail. And here we see lawmakers in Parliament. He was told his job was going to get more challenging from the year end, helping fuel speculation of a near-term scrapping of the sub-zero rate. And while that comment came in response to questions, his subsequent visit to the Prime Minister's office discusses monetary policy stance seemed more like a stage move aimed at delivering a signal that's suggesting that maybe the the Bank of Japan raises rates, this would be a staggering move. And you would think that this would cause pandemic in the bond market, cause a massive sell-off in bonds. And in fact, we're seeing in the U.S. markets today, well, only a little bit of a sell-off. As the yen extended gains, there you go, there's the desired result against the dollar to about 1.8%, with a poorly received 30-year government bond auction adding to the drama. The benchmark 10-year yield jumped 10.5 basis points as the market starts to anticipate higher interest rates in Japan. Of course, we know that even if they were to do it, it won't last long because there's nobody who loves easy monetary policy more than the Bank of Japan. Maybe beyond that, perhaps some of our former central bankers, such as Janet Yellen and Ben Bernanke, and soon to be Fed Chair Powell. But they won't be the only central banks cutting. So we head over to the ECB. As the ECB's Lagarde squeezed as the markets boost 2024 rate cut bets, it's pretty obvious. Of course, the markets are counting on the rate cut bets because the global economy is slowing. And this is what everybody doesn't understand. Central bankers aren't in charge of the intermediate and long-term end of the curve. They're a function of growth and inflation expectations. Inflation's been coming down, and when that goes down, growth is soon to follow. That's what we're seeing in the data. And yet with rapidly weakening inflation, a feeble economy, and one hawkish policymaker changing tack, traders are heaping bets on reduction as soon as March. Of course, now we're seeing bets across the board that, of course, the U.S., now the ECB, and who knows else are going to be cutting rates, as they're now seeing the rate falling to 2.5% by the end of 2024. We'll take the bet that is more likely to be at zero. If markets are right, the ECB will be among the first major central banks to cut next year, delivering the most aggressive easing cycle. But most officials show no rush to act, even though their new projections will need to acknowledge a changed economic backdrop with a lower outlook for prices. I'll stick with the prediction they're all going to be cutting in a big way. In fact, the Fed is, even though I know many of you say, Steve, the Fed's not going to cut rates. Rates are not going to go back down. Well, the bond market says they are. In fact, here we have the federal funds rate in blue against the 2-year Treasury yield in red. And here we can see the 2-year Treasury yield leads the federal funds rate down, and it's, well, starting to head lower now, suggesting that the Fed is indeed going to be cutting, and likely tells us at the next meeting here in December that the Fed Chair Powell will announce a continuation of the pause. He's going to talk rates that they could go higher, but he's absolutely going to pause and bow to the bond market and start looking to the way down. Because the U.S. economy is getting in further and deeper into trouble as the U.S. services sector gauge picked up on improved business activity. But hang on, it's not as good as the headline looks. Here we can see the ISM's services gauge rose 0.9 points to 52.7 last month, showing an increased expansion in the services sector. But keep in mind, we know where the manufacturing goes, services will soon follow. And the gauge of inventories, because look at this, as service providers jumped by the most since May. So you think about it, when inventories go up, what is that telling you? Demand is going down. And so yes, you get things like inventories that say, oh, look, the number's better. Well, yes, there's something being built, there's something being created, things are happening, but they're not selling. That's the issue. We want to see inventories moving, not building. Coinciding, here we go, with a smaller backlog of orders. That means you need fewer workers in the future. An index of sentiment about the level of unsold goods surged to the highest level since the onset of the pandemic. Wow, now we're seeing that pandemic data show up back here in the services sector, which risks a pullback on orders placed with manufacturers or other service providers in the coming months. So this surge in the data was not based on good things. It was based on things that are telling us are bad. That means an increase in inventories. We're seeing a decrease in backlogs. That means a broad decrease in demand. Look for the services sector to follow everything lower, and particularly now when we look at what's going on here with the labor market as U.S. recurring jobless claims fall in holiday week after big gains. So this is a big issue here. They're finally slowing down, but not that much, as recurring jobless claims, a proxy for the number of people continuously receiving unemployment benefits, decreased by 64,000 to 1.86 million in the week ending November 25th, marked only the second drop since early September. And following a surge the prior week, this is a big deal, my friends, because where continuing claims go, initial claims follow. It's real simple. The longer someone is on unemployment, the faster they eat through whatever savings they have left. We know that consumers have been drawing down their savings to spend money. They don't have a lot left, and their credit cards, well, we know they're near maxed out as well. So the issue here is the longer people are on unemployment, the less money they have, the less discretionary money they have. That's less money going into the economy and less people you need to fund it and keep it growing. And there you see it. Here we see continued claims in red, still near pretty high levels over the past couple of years. And what do you see? Initial claims still hovering fairly low levels, but we know as longer continuing claims stay high, well, initial claims will indeed soon follow. And that means Jamie Dimon's call for a recession is pretty much spot on. But on the backs of higher interest rates from here, not likely. Jamie, rates are going to fall into a massive recession and then a financial crisis. The only hope is that your bank is not in the middle of it, but we know there's a good chance it probably will be. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.